everyone. Welcome to our channel Talk of Town. We are here in our weekly series called Market Wrap, discussing markets, both global and India. So last week, finally, we've arrived at two rates of GST, which is 5 and 18%. I have two stalwarts with me representing each rate, hopefully today. I have with me Mr. Prabhanjan Rao, the SEBI registered investment advisor representing Elysian Advisory, and Ashwin Kumar, the director of DA Capital. Hi, both of you.
Hi Lakshmi, hi Prabhanjan.
Hi Ashwin, hi, and a thunderous namaskar and a masala laced morning to all of you. Where the charts dance wilder than Bollywood climax, the tickers run faster than a Mumbai local, and Ashwin today's market brew is hotter than your cutting chai.
So both of you, when you say we'll join in about 4 to 5 minutes, now I know you guys practice the exchanges. So
Most importantly, without your attention or
yes,
without your knowledge. Yeah,
yes.
great.
So like you said, the markets were both volatile and dancing, and of course, like Lakshmi said, the implementation of GST did bring in some cheer. But when we will talk about the options chart a little later, I'm still waiting for the 25K mark to be crossed.
Great, great, great.
Excellent. So I think we'll hear out Mr. Prabhanjan on the fundamentals as usual, from as far as the global factors are concerned, and then we'll come to Ashwin for the technical side of it.
Yes, sir.
Prabhanjan ji, over to you.
Great. Thanks, Ellen. As usual, let me talk about the crude. The crude, interestingly, has come around at $65.6, inching downwards from 67.8 in the past 2 to 3 weeks. The dollar index is around 98, which was around 97 last week. Rupee, which is 88.26, that was the previous close, which is again pressurized by the domestic and domestic equity weakness and FII flows. Rupee at 88.2 is a clear signal of stress. Whatever reforms we bring in, that indeed acts as a clear signal of stress. And this is only a weakening against a dollar, mind you. And it's
Yeah.
also tariff overhang and capital outflows which are weighing on the sentiment. The RBI, as usual and as always, it has to play a balancing act, defending aggressively, and it's again always risk draining the reserves. So it might also allow gradual depreciation, but it has to play a real balancing act. Coming to the US market recap on the weekly performance, S&P 500 gained 0.3% for the week. Nasdaq rose 1.1% over the week, though declined a bit, approximately about 0.3%. Russell 2000 posted a weekly gain of 1%. Nothing much has happened. It's on the same, more or less, it's on the same lines. But what are the key drivers, behind this movement? Is There was an interesting US, jobs. US employers added just 22,000 jobs in August, as compared to 75,000 expectations, which is far, far below the the weekly data drove this bond. This weekly data drove bond yields sharply lower and elevated expectations for a Fed rate cut at the September 17 meeting, with markets pricing in a full 25 basis points and even some odds against a 50 basis points move. On the tech and mega caps, which are driving the US markets, are Broadcom. It really surged 9 to 10%, against a strong earnings and AI revenue guidance, helping lift the overall sentiments. But contrast, the Luluman plunged to 19%. This is where the AI boom versus the tariffs for the US. That's where the US is battling around. And Tesla picked up 3.6% after unveiling a potential 1 trillion CEO compensation package tied to visionary targets. So, what are the key takeaways and summaries? Is strong close to the week, but not without caveats. Gains in indices were beyond by tech strength and dovish policy optimism. And I would also like to touch upon what all these global factors has an impact on Indian markets. Of course, I will talk about the GST in the later section, but the major macro factors: currency and the capital flows. The rupee languished near record lows, sinking to around 88.3 to 88.36 per USD. Persistent foreign outflows with FPIs pulling over 1.4 billion in September alone, exerted lots of pressure. The RBI intervention via state-run banks stemmed further slide, but the threat remained, potent. Uh, Another important thing for this fallout is that global Trump tariffs. The overhang shadow still remains, ramping up tariffs to 50% on the key Indian exports. I mean, needless to mention that the textiles, the jewelries, the seafood, leather, following the criticism of India's continued Russian oil imports. These sectors, which collectively account for a substantial portion of our exports, though it might not have a significant impact on the markets, but it's a sentimental impact. So, and also, of course, there are some domestic policy and structural shifts. Amid this pressure, the center announced a sweeping GST reforms, GST 2.0, effective September 22nd. So it has got a positive impact, but it has not remained for long. The second macro factor, the third macro factor indeed was like the crude and macroeconomic ripples. Oil prices after these earlier volatility appear to be stabilized, partially eroding inflation concerns. Still, with India highly reliant on imports to meet oil needs, any renewed supply constraints or geopolitical disruptions could quickly reflect in inflation and current account deficit. But, so I would rather consider the coming week to be again cautious, like how we were in the previous week. But during the weekend on Friday, U.S. President Donald Trump's, the tweets against India on the friendly relation and Piyush Goyal's comments, I think that will also play a lot of vital role in the coming weeks. So I think there are certain undercurrents that are going on the headwinds, and uh, of course, as Mr. Piyush Goyal mentioned, I think we should get into a trade deal with them. And also, we will be waiting for the Supreme Court's decision in US whether the US, the Trump's tariffs is legal or illegal. So these are the factors which we need to wait and watch on the global factors, which will have a significant impact on the Indian markets.
Excellent, sir. You did mention about the currency depreciation as against the dollar. Uh, you know, uh, I just would want to make one point here. During the course of the previous month, what has happened is while the FIs have pulled out money from the Indian markets, the inflows through the gift city, which is in dollar denomination to Indian markets, is has crossed 10,000 crores in a single month.
Yep,
Yeah, so the gift city route is gaining a lot of traction as against the direct investment into Indian equities. So this is an important point to be noted.
absolutely.
Ashwin, how does the technical factors look like as far as the global markets are concerned?
Absolutely, I'm. It's almost like a repetitive scenario of the last couple of weeks. No, I mean, I'm glad that the S&P 500 is holding. Neither is it correcting. The display of all big giants having a dinner with Donald Trump. I'm not sure how it's going to affect the the global markets, especially the US markets and the big tech companies in the next 1 week to 10 days. But overall, it's showing signs of exhaustion. While I still believe that there'll be one more attempt to move higher, what is important to understand, although we will not go into the depths of it in this video, is that S&P 500 in a time cycle wise is has reached a major milestone, and it's almost here danger zones, as we may call it in layman terms, that the index is entering, both in terms of time and price cycle. And does not, I always say this, does not necessarily mean that tomorrow we are going to start the crash. What I'm saying is that it is not time to enter new longs. Uh, Look at your positions, take a hedged bet, or just try and reduce your long positions, or do a covered call or some strategy that will protect, or trade your stop loss, and also try and protect the profits that you have made. but no new longs at this point in time is recommended in any US markets. I mean, of course, there will be certain standalone stocks which will outperform, which we will not get into the depths of it right now. But overall, gold, silver, I'm always happy to talk about them. They've just continued the dream rally. Uh, Although I was a little disappointed that gold did better than silver this week, but that's more of my personal opinion. That cannot affect the markets. Crude and everything has been volatile, but from the US market standalone, I'm just exercising caution.
Okay, great. In fact, people who have followed my strategy of 50% between gold and silver are smiling. Uh, back to you, Prabhanjanji. How does the Indian domestic factors look like? Of course, the major talking point, GST.
Yeah, I mean, of course, what a week it was. There's nothing else to talk, this week except the GST. So the India's GST overhaul, it it's rolled out most significant overhaul of the GST since its launch in 2017. The old five slab structure is gone. In its place, a simplified system with just four rates: 0%, 5%, 18%, and a sharp 40% for sin and luxury goods. Essentials like food, healthcare, and insurance get full exemption. Full kudos to the government. FMCG products, cement, autos, and appliances are cheaper. Meanwhile, tobacco, pan masala, sugary drinks, and luxury items now face up punitive rates. I mean, that
Yeah.
was as expected. Why does this matter? Because favor slabs mean favor disputes, lower compliance costs, and better trust in policy. And for years, we debated whether a paratha is 5% or 18%. That kind of confusion disappears now, So we don't see any more reels or shorts about, which caramel is costing what, which paratha is cost. I mean, under which bracket. So globally, the most successful GST systems in Singapore, Canada, Australia use through two or three slabs. India is finally aligning to that standard. I mean, since I'm based out of UAE, you see, UAE has got only one slab. So it really reduces a lot of disputes. Yes, the government admits to a revenue hit of about 48,000 crore to its exchequer, but context is more important. Monthly GST collections are already above 2 lakh crore. That's a 2% haircut, manageable, and cheaper goods spur consumption, which in turn widens the tax base. We need to think of it this way: cut shampoo GST from 18% to 5%, you lose your bottle, you lose per bottle. But if sales double, the pie doesn't shrink. Plus, more small businesses will join the formal system under the simple GST. So the base widens. So that's where we need to look into this entire GST. You know, uh, Macroeconomically, the impact is very, very crystal clear. Inflation could fall by 25 to 100 basis points as cheaper essentials pass through. That means more real income in household hands, especially for the middle class and the rural India. And with consumption formally nearing two-thirds of our GDP, this is an immediate demand stimulus.
Yeah.
The economists always estimate that a 0.5% to 0.6 percentage points boost to GDP in FY26. And also, along with the GST, the crude oil coming lower, and also Russian India buying Russian oil at $5 to $10 discount really is like a catalyst. It acts as a catalyst, to this GST move. So finally, if you want me to talk who wins due to this GST, this FMCG and staples, expect more rural demand to revive, healthcare and insurance, affordability improves, penetration rises, consumer durables, autos and building materials all get a place in price correction, just in time for the festive season demand. Agriculture and logistics gain from cheaper tractors, irrigation, and trucks. On the other side, the losers are, as always expected, quite obvious. Tobacco, sugary drinks, pan masala, and luxury consumption. These are all structurally capped at 40%. So, what should investors take away? Position towards the consumption and housing story, FMCG, durables, autos, building materials, healthcare, logistics. I think this is the theme which is structural. Structurally, it will tend to grow. But we always, tell our clients that stay cautious on tobacco and luxury because, mind you, some of the stocks, though I'm not recommending, it has done wonderfully good. Godfrey Phillips, for that matter, it has done really, really good in the last 15 months or so. But now I think time to slow down on those sort of stocks. Um, but however, disclaimer that we don't hold any stocks in this portfolio. It's not a recommendation. And of course, please do remember that lower inflation could even let the RBI lean dovish stance. A bonus for rate sensitive sectors like housing finance and banks. So this isn't just a tax tweak; it's a structural reform. We always feel, and short-term pain for the exchequer, but medium-term gain for the economy. Simpler taxes, cheaper essentials, higher consumption, stronger growth. In one line, if you ask me to say, India just gave itself a double Diwali relief for households, stimulus for demand, and fresh opportunity for the investors. So that's how we will look at it the next 12 to 15 months.
Excellent, sir. Very well said. In fact, I have 2 points to add here. Like you rightly said, I mean, already companies like Tata Motors have announced the kind of price revision on their cars, and some of the cars have a price revision of as high as close to 2 lakhs, which is
Right.
excellent for people buying cars in the near future. And I would like to put it on record that I did mention two rates in the beginning because I didn't consider zero as a rate because both of you are quite valuable to us and the channel, and I have not considered 40% because I'm sure we do not fall under the bracket of sinners. So for that we kept it at 15 and 18. Over to you, Ashwin, for the technicals.
Sorry, whether we are sinners or not, only the back channel knows. On the channel, we are not sinners. Just
On both fronts. But Lakshmi, you're a you know, you're an you have an art, you have a talent for constructing these statements and words, so you have to keep it up. Anyway, on the market front, I mean, we started off after the GST announcement. Markets naturally started off with a bang. I just quickly bring up the charts here. 25,000 is just becoming a major price
Resistance.
level to cross. We did try and in fact we came close to about 24,980, but the kind of call option volume that was there, it was quite natural that even though there would be a minor breach, they would not let it sustain above it. And as you saw, around 25,000, the selling kicked in. In fact, the very same day, and except for the fact that it was a gap up, by the end of the day, half more than half of the gains was erased, and the rest of the week was quite negative to dull. Although we have ended positive for the week, I think it was a more of a selling pressure, except for that one a day of a big up move. The bottom line, or the point I'm trying to make here is, as it is clearly evident from the chart, it's going sideways, or it is in a super congested range. Eventually it will break out. We know for sure this will not continue for long, but which side it will break out is anybody's guess, because I do not want to get into the art of, although we are into the markets, trading options, doing technical analysis for our study, I still do want to refrain from doing any sort of speculative giving any speculative inputs here, because at this point in time, market is, although fundamentally things are sound, we still have that the element of doubt that it might crack one more time before giving an up move, just to trap investors in. But having said that, uh, I've been telling 25,000 is a major milestone for the market to cross. But one point we should not miss is that the market is not getting into any severe selling pressure as yet. Every time it kind of tests that 25,000, there is some selling pressure. But also on the other side, we should not miss the fact that it's not like coming straight down, breaching the downside. It's still trying to maintain that range, and eventually one of the side is going to break out. and I want the investors to be prepared for both. And even if it breaks down, I don't see a major, like a 8 or 10% correction, maybe a couple of 2 or 3% correction, which should give us a good buying opportunity. Why I say this is the kind of increase in the put option selling volume around 24,000 level, at least for the next 1 week, is indicating that while it's still a scary number, it's still about good 700 points downside. The important thing here is when I tracked it for the next couple of weeks, 24,000, like the 25,000 was on the upside, 24,000 on the downside is also acting as a major support zone. 750 points is hardly around 2.8 to 3% today, which can happen in a day or two's time. So what we know is when the market goes down to 24,000, it will present itself with a lot of buying opportunities, especially from sectors which are benefited from the GST. And from the technical point of view, although we are not getting into any stock recommendations, I am particularly fancying automobile, which is already made a good run. And if you're asking me something is on the verge of a breakout, I am definitely looking at metal stocks to start with, which have, which are showing signs of a major breakout, followed with a couple of big names in the banking sector, which again is evident that we spoke about it last week. As long as this support zone holds, look for those buying opportunities with low risk and high reward. I think this is the time to start looking at certain big names in the banking sector, which can give you low risk and high reward opportunities. So that's for the week from my side, Lakshmi.
Wonderful, Ashwin. So, as usual, before we close, I have a quick question to both of you. Now, assuming that the GST has gotten a lot of cheer, and as individuals, if I have surplus, should I go and buy the product because I'm going to get it at a better price, or should I buy the stock of that particular sector? So,
I've
Prabhajan.
always believed. I think Lakshmi knew the answer. That's why you caught him smiling. I've always believed that don't buy just the product, buy the stock as well. So I have this habit of investing in the stock of the product that I frequently use. So my answer is don't buy just the stock. Not just the product, buy the stock as well.
Okay, Prabhajan ji, how about you?
I always go for a stock. So I can always say you buy a stock, make more money, and then purchase when you have that money.
Yeah. Smart.
Wonderful. I think, guys, those of you who wish to buy the product, I think time to go to the markets, and those of you who wish to buy the stock, time to enter the market. So, with this
Very
note,
very
I
well said.
think we would want to conclude this episode. As usual, none of the discussions we have had constitute any sort of investment advice. These are purely for educational purposes. We'll be back in a week's time from now. Until then, take care. Bye bye.
Bye bye.